Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Valen and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here as always. We do appreciate you taking a look or listen at the show. If you haven't done so already, please share this with somebody wherever you're watching or listening to it. Leave us a review, a comment, a like, whatever you could. We would really, really appreciate it. So today we're talking about the private lending refi boom, and that might sound a little unusual, and that's because at times it is. Like normally when you hear about a refinance boom, it's because it normally means that long-term interest rates are low and residential and commercial property owners are refinancing for a lower rate. That's typically what that means. In the private lending world, this uptick in refinances could be for all sorts of different reasons. And it usually has to do with something funky going on in the financial markets and the lending markets, the capital in our space. But recently we've been seeing all kinds of different scenarios where we can take advantage of good refinance situations, help out the borrower, win-win for everybody.
Yeah, sometimes I feel like we'll have an unfair advantage of what's going on in the local real estate market because we just get so many leads that we're talking to a lot of people and just kind of seeing what types of deal flow is there. Hey, is there really good fix and flip buys, or or people trying to get capital on their free and clear rental properties and they can't get capital. So like sometimes I think we have the hack, and sometimes I think it's just the nature of the business where you get an influx of a certain type of deal. And over the last 2 or 3 months, like we have gotten a lot of refinances, very, very low LTV refinances, mostly pretty qualified borrowers in general. And, I think it's important to share the pros and cons of refinances. Now, I know some lenders in the group, in the Hard Money Mastermind group, they're like, oh, I don't really ever do refinances, partially because maybe it's not on their radar. It's not something they do. Partially because they do have more inherent risk, a refinance compared to a fix and flip. Like, I'll give you an example. So if you're doing like a cash out refinance on a free and clear property and the money's not necessarily getting used to renovate the property to resell, let's say it's a rental property. They want to use the money to buy another property that maybe you're not putting a lien against or attached to, or they're injecting into a business or something like that. Now, obviously they can't use it for personal or consumer use. They can't refinance a ex-primary residence that had a primary residence consumer loan. So this is obviously assuming these are still business transactions, which ones we do are, but make sure that's definitely the case. You still don't really have a full control over where the capital is going. So because of that, you don't really have full control over the deal or what the exit strategy is. If someone comes to you and they have a $200,000 rental property and they need a $100,000 loan and they have good credit and they're not planning to sell the rental property because it's rented, and you give them $100,000 to go buy another building, inject into a business, whatever the case is, you don't have control over of how they're going to repay the loan. Like you don't. Are you in a good collateral position? Yeah. Chances are you're in a very good collateral position. Can the debt service from their rents cover your mortgage payment? Probably. But that doesn't mean you have a good exit strategy. And in essence, you're giving them cash in pocket, in hand, to do whatever they want with that you can't control. So that's where kind of the risks come in. And we're going to talk about a few case studies of what we did, of some of the deals that we've done over the past few months, just so you can kind of get your creative juices going in your brain and be like, oh, shoot, I get deals like that. I see that does make sense. But those are some of the risks that do happen compared to a fix and flip, where you're clearly using the capital to buy the property, fix it up with the goal of reselling it.
Yeah, let's keep talking about the refinance exit strategy for a second before we go into some of the case study type stuff. So it is very, very common to speak to a borrower. Whatever the motivation for the refinance might be, a loan getting called due is a common one in the past couple of years and just very recently too. But whatever the reason might be, they want to take some cash out of this property that they own free and clear. Or maybe even you're paying off the current mortgage to be a first mortgage. And their exit strategy is to refinance within the loan term. Most of us do 12-month loans. So that's not that far into the future. And so taking a look at their financials, if it looks squeaky clean and they're going to get a refi approved, great. Sometimes that's the case. Oftentimes it's not the case. Yet you'll still hear the borrower say exactly that. Oh, no problem. Yeah, I know my credit score is only 610, but it'll be fine. I'll get my score raised by the end of the 12-month term and I'll be able to refinance. It's like, all right, I hope so. I want that to work for you. I hope that is the case, but we need to talk about some stuff ahead of time and set expectations, really. Like having a frank conversation with the borrower and being like, look, based on your financials, what I see here, whatever it might be, oftentimes it's credit, but not always. It doesn't look like you're going to get a refinance approved. If that's the case and you can't get it approved to pay us off, are you willing to sell? And they'll usually say, yeah, if I have to, I would sell. It's better than, foreclosure, obviously. That doesn't mean they want to do that. And that doesn't mean they will do that, but they'll usually say that. And we have found it's helpful to put that in writing through a use of proceeds form that, it's something they can fill out saying, what's your primary residence? What are you using these proceeds for? What kind of business use? How do you plan to repay the loan? And also put in there, if the refinance isn't approved, then you're willing to sell. Because having that is going to help you down the road at the end of the term. If that comes to pass, that they can't refi, mind you, we see situations all the time where somebody can't refi out, but we also see the opposite. We're actually kind of surprised that they did get a refi, a lender, given the situation, even with a loan in default sometimes, to pay us off.
Yeah.
So just something to be aware of. It's an important thing if you're doing refinance loans, and we believe that you should. It's something to be very, very aware of.
Yeah, and make sure if you're lending money, you're pulling credit. There's too many lenders that we know, a lot of them in this group, that are not pulling credit. So you don't even know. You're like, even forget refi, even fix and flip. If someone's or like the burst strategy, they're trying to buy the property, fix it up, and then rent it out. If you're not pulling credit as a private lender, how the heck do you know if they can execute on that? You don't know what their credit is, right? And most of the time, you can ask people their credit score, or potentially, have them send you an old one, and most of the time, people are fairly honest with that. But you got to pull credit. You got to understand what's going on. You got to go through that stuff. So, in essence, the extra strategy is the biggest risk on the on any property that's a rental property. So if they own it and they're doing a refinance with you, and they're not looking to sell the property immediately, the exit trade is going to be a risk. Same reason our commercial loans are outstanding for a long period of time, because the goal is to use us for bridge capital. Most people don't just buy a commercial building and then flip it right away. They want to hold it for long-term cash flow. The exit strategy is hard. It's hard to get bank money. Is it available? Yes. It's just another layer that you got to underwrite. So let's go through a few case studies on some deals. Just a few deals that we've, done over the last few months. I did a case study like this in our Hard Money Mastermind group. We typically do case studies once a week of the deals that we do. Like we just kind of do a live 10-minute of like, hey, here's the deal that we did this week, or a few times a week or once a week. We'll do that just to, so people see kind of what's out there. So, okay, here's an example. And I think a lot of these deals, most lenders might be like, wow, how did you even get that deal? Like, that seems like too good to be true. Well, they're out there. You just have to, in essence, look for them and make sure borrowers know to call you. And, getting a bridge loan or a refinance from a bank is challenging, right? They're going to look at all their financials. They're going to want to make sure all their tax returns are filed. And if you're doing stuff on like a commercial property, there's no DSCR capital available. So those deals are even easier to get, right? Because there's no kind of additional type of capital sources for that. So I'm going to tell you about one that we did first. And this one's, really is a home run, but like, I just want to state this one just so, you kind of understand what is out there. So a restaurant owner that we have done some loans for in the past reached out to us and was like, hey, I have this property free and clear. I need money for an HVAC system that went out, and I only need like $100,000 or 115,000 or something like that. And keep in mind, this was a building that was worth, well over $1 million in an area that we know. We're familiar with it. The business does well. He's got he's got 700 credit. But I also know that he'll come to us when he just needs quick money. Is he bankable? Yeah, for the most part. Does he want to go through the banking route for like $100,000 and be like, okay, cool. Show me your updated, like the bank probably be like, hey, show me your 2025 tax returns that aren't done yet. Right. And if you don't have that, okay, give me updated P&Ls. Let me get 3 years tax returns. Let's go do a new appraisal. stuff that like he doesn't want to freaking do for $100,000 loan, right? Pay me $10,000 for it. We'll do this. Now we did now keep in mind, we did do a loan on this property in the past years ago. So we had an environmental we were comfortable with. So I didn't have to get some environmental stuff, but nevertheless, we were able to get this thing closed pretty quickly for him just based on when title work was done. We just had to get title work done, and that actually took a little bit longer than expected. And, we charged our normal thing, $12.99, 3 points, 1-year loan. Now, here's the thing, exit strategy. How's he going to repay this? He's not selling the building because he's got a profitable restaurant in the building. He's not selling the building, and I know that. So the payoff options typically are sell, refinance, pay off in cash. Those are typically the things. Paying off in cash is his exit strategy. He's not selling the building. He's not going to freaking refinance this thing. He doesn't really want debt. He gets large sums of cash here and there. He's going to pay off in cash. So that is a business decision based on your comfortability of the borrower. Do they have the ability to pay off in cash? The answer is yes. Will they? Maybe. But they have a lot to lose. They're not going to walk away from this thing. So we're comfortable in this situation that they have the ability to pay us off.
Yeah. I mean, this is a long time borrower too. So oftentimes when you hear, depending on the situation, if you hear my exit strategy is pay off in cash, the initial reaction for any lender is really? Is that really going to happen? It does happen though. It does happen. And granted, we've lent to this guy 10 times. So we're not worried about him, but it just goes to show you the needs that, investment property owners could experience, right? In their business during their career for all kinds of different reasons.
Yes. Yeah. And it's, I wanted to use an extreme one like that because just to show what is out there, right? Getting on commercial stuff, there's no competition. There's very little competition on commercial stuff, right? On the residential stuff, sometimes they can get DSCR loans or they can, push through, with other residential hard money lenders, but the commercial stuff, there's very little competition on that. I mean, our max LTV in a commercial loan is 50 LTV. We're typically 40 or even less than that. And we're still getting, we still get a good bit of that because they need liquidity on some of these things, for major purchases, wherever the case is. Okay. So another deal that we did was a borrower bought a property with 1031 money, paid about $650, it's either $650 or $750. I don't remember. About a year ago, got 1031 money on it. He only, and he got a loan of $100,000 from the lender. So he had a loan on the property for $100,000. He used 1031 money to buy the rest. He didn't have the whole thing to pay in cash. But so keep in mind, he's got, $550, $600 plus $1,000 of cash into this thing at this point, and then got the rest through a hard money lender. Came to us and he was like, hey, the hard money lender called my note. It was a 1-year loan. They don't really want to extend it. So I need to pay them off, and I'm trying to buy another property and I need another $100,000, give or take. Right. So again, and this was a rental property and it's bringing in $3,600 or $4,600 a month. I can't remember exactly. So I was under the impression he had good credit. His credit wasn't as good as we expected. So we made a business decision of hey, listen, what's your game plan to get out of this thing? You're not going to sell this rental property. We know that. Well, I'm putting money with my own cash towards this other building and I'll be able to sell that. Do we control that? Now, technically, I could be okay, we want to put a lien against this. Well, if he's getting a first mortgage, maybe we put a second mortgage. If it was a tight, sticky deal, that might be something that we would do in order to control the exit strategy. Not because we need the collateral from the other building to control the exit strategy in the other building. But we made a business decision of hey, we're going to give this guy a $250,000 loan. We're going to roll in 3 months of prepaid interest. We're going to pay off his current loan. He's going to get $100,000 in cash for his deal. And, chances are it'll be fine. We're at a 30 LTV.
No, I'm not worried about it. Yeah, you paid what, $650 for it, and our loan's $250?
Yes.
Yeah, about that. And it's also in a state where we can foreclose non-judicial. Very, very.
Keep in mind, we've done low LTV loans for different situation borrowers that didn't work. And I'll give you an example of another one. That's a good situation because he had low credit, but he brought a lot of cash in. And a lot of cash trumps a low credit score. Having a high credit score and no cash doesn't work that way. And if you have not great cash and bad credit, that's not going to work either. But if you have a lot of cash and not great credit, I'm not saying equity, I said cash, right, to put into this deal. Okay, So this isn't a case study we did, but like this is a deal that had failed in the past that we did in DC, Washington, DC, where a borrower inherited a property worth like 6 or 7, like a lot of money. Let's call it $600,000. And he needed $100,000 to go renovate the property. And he inherited the property, didn't really have much money. He had bad credit. He needed $100,000 to renovate the house. We gave him a $100,000 loan with a construction holdback, and he completely messed up that deal. Because high construction, low credit, recipe for disaster, typically. And also, he had, in essence, the numbers are similar, but he didn't have a vested interest. Like he didn't put in any money on that deal. He inherited that deal, right? So it makes it way different in that particular case. So that's an important part. Like equity is different than cash, right? He inherited that property in DC. That's why it was an issue. And I remember this deal vividly because he came back to us and is like, "Hey, I'm not going to finish the project. I'm going to need more money. Plus, I'm going to need more time." And we did a refinance on him, right? For the second time. And then he came back again a year later. He's like, "Hey, you need more time?" We're like, "Nope, we're not doing a third deal. Like, we'll do a second refinance."
For this one too. That was a long time ago.
I know, but that was a good example of
Yeah.
a similar situation where it's a no-brainer equity deal, but like the borrower's just not going to perform. They don't have a vested interest in it. They're putting a ton of money into it. They'll do it. One tip to do is if you are going to do a refinance for somebody, you need to pull land records, public records, get notes, deeds of trust, or notes, HUDs, and see what they paid for the property. If somebody buys a property for $100,000 in 2020 during COVID, and now it's worth $300,000, and they're like, "Yeah, I need a cash out loan of 180, 200, you'll still be under your 65 LTV deal." That's not working, right? Because all they have at this point is appreciation and maybe some sweat equity. They don't have hard-earned cash in that thing. So there's a difference between a property worth $300,000 that you paid for in cash and a property that's worth $300,000 that you inherited, or a property that's $300,000 that you got a full exposure loan on, and now you're trying to, you know what I mean, in that situation. So cash is important.
Yeah, and I mean, on the inherited property subject, that's relevant to this refi conversation too, because when potential borrowers come our way and they have inherited a property, the transaction's a refi because they're already taking. It's not a purchase because they already have the deed or they're about to get the deed just from the estate without having to do a purchase transaction. So our loan transaction is a refi, and inherited properties have much, much more risk because the people who are about to own this property, there's a good chance, a high likelihood, they're not in the business of real estate investing. They were given this property by a relative, and now they want to give some work to it. And anyway, just a little side note there, not really the point of this pod, but watch out for inherited property situations.
Yeah, I mean, and listen, we can go through a dozen of these we've done over the last 3 months. They're all similar in nature. Like you just want to dig in a little bit more on a refinance. You want to dig in a little bit more. You always want to get the HUD one from when they purchase it. You always want to get their, you always want to see kind of if they have any deeds of trust on it, before you pull title and stuff. Try to go on land records, see if you can find that stuff just to see, just do a little bit extra due diligence on it. And if they have a current mortgage on the property, you gotta get the promissory note. You gotta make sure that current mortgage on that property is not a consumer or a primary residence mortgage. And that happens a lot. The most common example is this. Somebody buys a property 10 years ago for $400,000, $300,000, call it. 10 years ago, they bought it for $300,000. They got a 30-year Fannie Mae loan. 5 years ago, it was their first time home. 5 years ago, they move out. Maybe it's a townhouse and they buy a new property and they turn it into a rental property. Very, very common. 10 years later, through the amortization cycle, now they owe like $100,000 on it as well, right? And they paid a lot of money for it at some point, right? So they've been buying it down. They come to you, they say, "Hey, I have some tenant turnover. I don't want this property anymore. I think I'm just going to, can you refinance, take some cash out? So as soon as these tenants turn over, I can just sell it. It appreciated a lot. I can make money," right? Well, the problem is you can't pay off that consumer loan. That was a primary residence loan. Is that considered a primary residence? Probably not considered a primary residence anymore, but it was a primary residence. And they have a primary residence consumer loan that you cannot pay off. It wasn't a commercial loan to begin with, so the proceeds cannot go towards that. And that is a very common misconception.
90% of lenders don't know that. We probably didn't learn that for, I don't know, 5 or 7 years in the game. And not that we were doing that many of those situations, but it probably happened somewhere in that time because you just don't know. You're like, it's a legit rental property. They don't live there anymore. Here's their primary over here. It's rented out. Here's the lease. This is clearly a commercial loan, right? But then there's that little piece in there. It's not even that little, but you can see it as little. What are the proceeds being used for? If you pay off a primary residential mortgage from 15 years ago when they used to live there, that's consumer use of your loan. A no-go, a big no-go, not going to fly in court, all that stuff. Most people don't know that. When we have that conversation with lenders in the mastermind, it is always news to me every time.
Yeah. Oh, yeah. We learn from experience. That's what happens. Like you said, I don't know for a fact if we have done that in the past, but we probably did years back and didn't know until we learned, until we knew, until we figured it out. So that's part of our underwriting. If you're doing a loan like that, you need to get their deed of trust and mortgage, you need to get their promissory note, and make sure they're filling out some sort of use of proceeds form prior to your loan doc set. Obviously, your loan doc set's going to have an affidavit that shows its commercial purpose, but have them fill out themselves or in handwriting what the use of the proceeds are going to be going towards to make sure you control it. There was one time that we were nervous about where the proceeds were going, and the guy promised that they're going to this particular thing. And for some reason, I recall this deal. And for some reason, still wasn't 100% sure. So we added all of the entities that he was, like all the business use that he was doing. We added on the HUD-1. He's like, you can pay this on the HUD-1. I don't care. Like, it's either I'm getting the check to write it out, or we're going to pay it directly from the HUD-1. Obviously, that's the safest way to do it, but like, we're not doing that on all these deals. But we are making them, in writing, in their own handwriting, state exactly what it's for. And, you can't pay off card debt. You can't pay for your kid's college. You can't buy a new car. It's like, we're talking about business use, right? So renovating a property that they already have, buying another property, injecting into their business, buying an HVAC system for their restaurant. That's business use.
It sure is. If you play your cards right, there's some really good deals in refinance situations. Just hope that this info here and some of these case studies provide some clarity on what to do, what not to do. We appreciate everyone checking out the podcast. We hope to see you guys inside hardmoneymastermind.com and here next time on the pod.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.